So now that we know what implied volatility is and what effects it has on option prices, we know that if the volatility is high, then option prices are going to be higher. And we can look at a stock and look at its last 12-month prices, and we can know what the volatility level is for that stock. But this is what you call historical volatility. This is volatility based on the stock's prices in the past 12 months. It doesn't tell you anything in the future. And this is critical because options are about the future, whether it's 30 days away, 60 days away, or 180 days away. Options are about the future. And then to know the price of an option, you need to know the future volatility or the expected volatility of this stock going into the future. So how can we calculate the volatility of the stock for the future? We really can't do that. But fortunately, we have a way to calculate implied volatility, and this is from supply and demand. And this is a key concept of implied volatility as it applies to option prices. So this is really the most important concept here. So let's look at what we mean by this. We have a way of calculating implied volatility from supply and demand. So in an options market, you have supply and demand. You have market makers on one side who are willing to take your orders, and you have traders, institutional investors, and many other players who either want to buy or sell options. So the market shows you a real-time picture of the supply and demand for any particular option. If more people want to buy options, then there is more demand, and more demand means higher option prices. And what the market makers do is they can see the order flow coming in. The market maker is a particular individual who's representing their firm on the options exchange. And they can see the order flow coming in, and when they see a particular demand for certain options, they are going to adjust the prices. They're going to increase the prices, because then whoever wants to buy those options are going to have to buy it at a slightly higher price. So the market provides a way to use the supply and demand that exists in the market to adjust option prices. So if we can know what the market is saying about the price of an option, we can calculate its implied volatility. And that's why it's called implied, because the calculation of the volatility is coming straight from the market. So what exactly do we mean by that? Let's look at our options pricing formula again. We know that option prices are a function of four variables. The one is the current price of the underlying and the strike price of the option. These two factors tell you how likely an option is going to end up in the money. So those two factors actually come down to the same factor. Then we have the volatility of the underlying, or the implied volatility of the stock. And then we have the time remaining to expiry. So out of all of these, we know the current price of the underlying stock, we know the strike price of the option, we know how much time is remaining to expiry. And the only thing we don't know is the volatility of the underlying stock going into the future. We do know the volatility of the stock as it was for the previous 12 months, but that really doesn't help us. What we need to know is the volatility of the stock going into the future. And there's no way to really know that except to say that option prices observed based on the supply and demand implies a certain volatility in the stock. So if there is more demand for put options or call options, the market makers are automatically going to adjust option prices. And so this is what we mean by supply and demand. So if we see what option prices are based on the supply and demand, then we can back out the implied volatility from this formula, because that's the only unknown in this formula at this point. We know the option prices, we know the current price of the stock, we know the strike price of the option, and we know the time remaining to expiry. And based upon the supply and demand, market makers are going to either take the prices of these options up in case there's a lot of demand, or they're going to take the prices down in case there is no demand. So this way, we know the option prices, and therefore the calculation of implied volatility is backed out from this formula. And that's why it's called implied volatility. So now what we're going to do in the next lecture is we're going to see some real examples of how this implied volatility manifests itself into stock option prices.